Well, good afternoon, good morning, or good evening, wherever you are in the world, and welcome to this Minds and Money forum. And we're going to be looking today at battery metals, powering the energy transition. Let me just introduce myself before we get around to the panel. I'm Clyde Russell. I'm the Asia Commodities and Energy columnist for Thomson Reuters. I'm based in Australia, but I spend a lot of time, well, I used to pre-pandemic, traveling around Asia, hoping to get back into more travel as the days as the world economy reopens after the pandemic. But basically, what I look at is commodity markets and what are the trends and what are the driving factors. And there's probably not many commodity markets that are more interesting or hotter than battery metals. And I think that's what we're going to be focusing on today, just exactly what is happening in this space. And I'm going to be joined by a very strong panel of investors and people who take, the people who allocate the money. And that's where, I always think the best advice ever given in journalism and probably in life is follow the money. And that's where I think we're going to be looking at today. Just to set the scene, I think we've had there are two very strong factors driving battery metals at the moment. One is the accelerating and more urgent need for action on climate change, and battery metals are obviously very much part of that solution. We had the IPCC report coming out yesterday, which was very clear in what needs to be done and how urgent that needs to be done. And then the other factor, it's been a bit of a wild factor. It's mainly been seen as impacting energy markets insofar as Russia's invasion of Ukraine. I think that is something that we still don't understand the full ramifications of, but I think it's certainly going to affect the flow of energy commodities in the short term and the medium term. But in the longer term, you end up with a very interesting situation. Is Europe going to really try to wean itself off Russian gas? And if it does, how much is that going to be driven by effectively a switch to renewable energy and battery storage to sort of drive that all up together? So let me introduce the panel, and then we'll start to get everybody's initial thoughts on where we are in the market and what they're looking at. So joining us today, we've got John Hykawy from Stormcrow Capital, Tim Hoff from Canaccord Genuity, James Wallbank from Ibaera Capital, and Bert Koth from Denham Capital Management. I think I'll probably start with John, just asking him where. I'm going to ask the same question to everybody: was where do you see the current state of the battery metals sector, and what are you looking at? What's the most exciting part for you?
Wow. Okay, Clyde. So the first part of your question, I could probably take up the whole hour. I'll try not to. We've had an interesting couple of years here, obviously. The pandemic and the disruptions in the supply chain that were a result of that has thrown these minor metal markets head over heels, because a lot of what we do in the minor metals, given the amount of compound growth we're seeing in battery demand and the like, we're having significant issues keeping up with demand, never mind having supply disruptions left, right, and center. So obviously what we saw over the last year was a resurgence in demand, a restocking effort that had to take place because stockpiles of some critical feedstocks, especially on the lithium side, were heavily depleted in China. And as a result, prices went bananas across the board. Hopefully this year, we're going to see a little bit of a more reasonable state of change and reasonable state of affairs in these minor metal markets. Prices should start to relax a bit. We're already seeing that in rare earths. We're already seeing some evidence of that on the lithium side. We're not going to get back to historical lows. I don't think we're ever going to touch historical lows again. The bigger question for me, though, is based on the pace of impact we need to have on carbon emissions globally, whether we are in fact chasing the right technologies to do it. For example, in these forums, we talk about batteries and we talk about electric vehicles a lot. One of the big questions I have is whether we're actually dealing with something that's going to make enough of an impact on the carbon emission question in the time frame that we need it to, or whether something else needs to be done, and then how quickly government might actually start to realize that and push for the right changes.
Yeah, I think there's a lot to unpack in that. At the moment, it seems very much that we're, as a globe, trying to push the electrification. You keep on hearing the age of electricity, and I guess battery metals are batteries are seen as very much part of that solution. I think let's move on to Tim and see what his initial thoughts are on where we are just in the battery metals sector. I guess if I could ask him a little more specific question, it's always, is there enough investment? And because it seems to me we're setting ourselves up for shortages in coming years. But anyway, Tim, your thoughts, please.
Yeah, thanks for the question. Yeah, it's a hard one because we deal with this every day at the moment, and we're certainly trying to find as many places as we can find to incentivize more supply. But is there enough investment? I think the answer is a pretty easy no, and we see that from the pricing today. It's fairly obvious. I mean, we're about 4 times through incentive pricing for lithium, so we will see something happen there. But I think we tend to overestimate what we can do in 1 or 2 years and underestimate what we can do in 5. And so we'll see some of that supply come through. But the analogy I use is it's like trying to tee up a golf ball on a moving train and hit a hole on another moving train. This is the supply demand both going like this, and it's getting it right is near on impossible, I'd say. So I think we've called pricing reasonably well, and we're still off by probably 50% most of the time and within a couple of months of writing our reports. So is there enough investment? I think the answer is at the moment, no. But we're starting to see it line up. We're starting to see organising bodies. We're seeing America start to announce new funds and systems to start funding. We've seen Europe be incredibly organised through its European Battery Alliance. I think when you look at that and you see the success that Europe has done, they're really the model that the rest of the world should be replicating and saying, okay, you need to get your ducks in a line, guys. This isn't going to happen through free market activities. China is perhaps the best evidence of that. So I think we'd like to see more alignment across the board, but at the moment we're still looking for more and more opportunities to provide more materials, because this is at the moment it's an enduring thematic. The electrification of the globe is probably one of the the biggest challenges of the next decade, and it's pretty much the only way we're going to be able to achieve any type of carbon neutrality or even moving towards it.
Well, let's move on to James. I think the message we're getting so far is there's a lot of opportunities out there, a lot of need for investment. I guess, someone sits in your shoes, would you actually see lots of opportunities? Are lots of good projects coming up, that you want to get involved in? Or is it actually quite difficult to find the right kind of thing that you're going to allocate some money into?
Yeah, thanks for the question. I think, with the last 20 years, it's been increasingly difficult to find assets that are economically attractive. But also we've had, so it is difficult to find attractive investments. I think certainly Bert, as an investor in this space, would agree with that. I think the key thing from our point of view in terms of what's happened in the marketplace, why it's difficult, is that, fundamentally metals prices decoupled from supply demand dynamics probably 10 to 20 years ago. And so what we actually have in the commodity pricing and also to a degree in the equities marketplace is valuation based on sentiment rather than actual underlying supply demand dynamics. So the issue is, has electrification and decarbonisation, has it just appeared in the last 12 months? It's been coming for the last 10 to 15 years. So, if you actually look at what the market fundamentally needs in terms of new projects and new development, it's been blindingly obvious for the last 10 years that we need more investment in the space. So actually what we're seeing now is just the market sort of, waking up to market shocks and events to actually stimulate commodity supply. But, it fundamentally, which will stimulate investment in the space, but, 10 years too late for what we actually need to meet market demand. So it is important to understand that those two dynamics playing out, that commodity pricing and actual underlying supply demand are pretty much not completely unrelated, but mostly unrelated.
Certainly, there seems, I mean, I look a lot at energy commodities, and the message I get from physical traders is very different to the message that the paper market's putting out. So I think that dynamic does play out quite a lot in commodity markets currently. Last but not least, let's go to Bert and see what his perspective is on where we stand with investment in battery metals at the moment.
Yeah, first of all, just as a reminder for electrification, you don't only need battery metals, right? One of the biggest choke points is actually copper. And because if you look at when we made our calcs, you need roughly between 6 and 8 escondidas in the next 18 years, just as a result of electrification. And if you include the non-electrification demand drivers, you need another 15 escondidas by the end of 2040. And it's completely clear this is not going to happen. And I mean, obviously, the same dynamics are true of a lot of battery metals as well, right? I mean, the 1,700% increase in annual lithium demand, the whatever 180% increase in annual earth demand. So I'm actually quite in agreement with John's point that I made before. Are even the right technologies or means to reduce CO2 emissions are being chased? Because when we look at the global supply pipeline in any metal or mineral, meanwhile, we as a fund, we start to doubt whether, irrespective of the amount of investment that goes into the sector, if actually the raw material base for electrification, renewable energy can actually be established, period. So I think there's a theme out there that irrespective of how much money you actually invest, you will not have enough copper, tin, rare earth for the electrification, for renewable energy, EVs, etc., etc. So I think this is a real risk. Again, coming back to copper, the last time that a real meaningful copper deposit on the planet was discovered was Kamoa, right, which was like 14 years ago, right? And that's only half the size of Escondida in its annual production, right? So when you live in a world where you need in the next 18 years another 13, 14 Escondidas, I got no idea where that's going to come from, right? I mean, you look at the supply pipeline of copper projects and you can immediately strike half of those off the paper because they're not going to happen for jurisdictional technical reasons. So again, this is not just a battery metal discussion, right, on minor metals. There's actually a much broader picture here. In terms of the follow the money, I mean, first of all, I totally agree with James. There's actually not that many projects out there that actually we feel are attractive enough for investment, because the issue is, if you have to believe in paradigm change, meaning higher prices, what it means is, in the absence of high quality projects, you have actually to climb down the quality ladder, and you actually have to make yourself believe that smaller, lower grade, metallurgically more difficult assets are going to win the day, right? The problem with those is they're more difficult to implement from an execution risk point of view. So there's already higher risk to stuff something up along the way. And God forbid if you actually get it wrong on your call for permanent higher prices. I mean, that's how tens and tens of billions of dollars were lost in investor capital when the last super cycle ended, when everybody says China's going to keep on growing forever and building infrastructure forever and the price is going to stay high forever, blah, blah, blah. See what happened? Everything came down and tens of billions of dollars of capital were wiped out, right? So this is, long way of saying, one cannot take as an investor the risk that you permanently underwrite higher prices, because what if there's a change in battery technology and all of a sudden you only need half the lithium, right? Boom, price comes down and then the money is lost. So that means the price forecasts as an investor you have to take, they still have to kind of some resemblance to what happened historically for your underwriting, right? If you use that, then a lot of stuff is not going to make any sense economically, right? So it's really difficult. The other thing is the downstream aspect. You're increasingly, the amount of mining projects that we see, especially in the battery metal space, you've got to build downstream refineries here, and hydroxide plants there. All of that are not metals and mining disciplines, but these are very complicated specialty chemicals disciplines, right? With actually pretty high execution risk. Again, at least speaking for the metals and mining specific investment community, are we the right guys to invest in building sophisticated downstream? The answer honestly might be no, because of the complexities, right? I mean, we are building at the moment what we believe is the world's largest heavy earth operation outside China, Cerro Verde, in Brazil, right? And it's complicated. Yeah, it's really it's complicated. It's easily said we're going to bring on that supply. It's very complicated. So again, is there enough investment? No, there is not. Clearly, the world needs more discoveries of meaningful deposits, right? Are there enough really attractive projects that tick most boxes ready out there to invest in on a large scale to make a difference for the electrification? I'm afraid the answer to that also might be no. Plus, are there enough like management teams to invest in? The answer, I'm afraid, is no.
It's I mean, just sort of, if I can briefly sort of summarize where I think, you know, what we're all saying is there's a dramatic need for considerably more investment. There's not enough good projects to actually go around. And, you know, no matter what we do, we're probably still going to end up short. So I guess the next question then is, how do we close some of this gap? I mean, does it really have to be policy-driven responses? Do the major mining companies have to sort of say, oh, well, we're going to have to play in this space? How do we sort of close the gap between what we think we're going to need, the risks involved in getting it, the money available in order to fund those risks, the lack of expertise? I mean, these seem huge issues which a lot of people just chuck their hands up and say, oh, man, it's all just too difficult. Let's cook the planet and drill, baby, drill, and burn oil and coal. But if we are going to try this, how are we going to go about it? So, John, I see you've been nodding your head quite a lot there. Let's get your thoughts on how we actually close some of this gap.
I don't want to throw my hands up in the air and yell, drill, baby, drill, Clyde, because I don't want to in any way resemble Sarah Palin at any given moment. But what I would say is I do agree with both James and Bert in the sense that we're in a situation where obviously making a good investment in the space depends seriously on your ability to try to predict what future prices of some of these materials are going to be. But I think given that we haven't even really managed to cover off the question of whether electric vehicles, especially battery electric vehicles, are the right technology, we make that problem almost insurmountable. A good example, the IPCC report that you cited, Clyde, that came out yesterday, your time, it said flat out, by 2030, we need to reduce carbon emissions by 43%. Okay, that's a number. It sounds big. It's a massive problem. But the transportation sector, and I mean the entire transportation sector, from passenger vehicles to rail to air to you name it, transport vehicles and the like in the United States is 29% of carbon emissions. Okay, so if we reduce that to zero, we're not at 43. Actually, we're not going to reduce it to anywhere close to zero effectively, because the United States used over 500 billion liters of gasoline and over 200 billion liters of diesel in 2020. If you take all that energy out of the equation and you require it to be replaced with electricity, the United States is going to be burning an awful lot more natural gas and coal, because that isn't going to come from solar and wind. It's impossible. And so are we headed in the right direction by hoping that a few people will buy a battery electric vehicle over the next 20 years and save us? The answer to that is definitively no. What we should probably be aiming for, and I haven't seen this in any policy level document from any government anywhere, is what the IPCC is calling for, which is if you can reduce the amount of carbon emissions even by a little bit now, it matters more than worrying about a lot later. And what I would suggest is we start looking very seriously at smaller batteries in a lot more vehicles and start pushing hybrids and plug-in hybrids much more than we are. If we go down that route, we're talking potentially about different batteries with different lithium demands, maybe a lot less demand for nickel and cobalt, because our energy density of those cells doesn't need to be as high as it is for a battery electric vehicle. So all these problems that we're talking about in making investments they tend to come back and sit right at the feet of the technology that we've chosen. And I'm not sure that we've chosen the right one, or maybe the one that we're going to rely on yet.
It is interesting. I've had a look. I mean, in Australia, battery vehicles are extremely expensive relative to their conventional petrol-powered alternatives, and we currently have a government that has no interest in changing that. But hybrid vehicles are quite interesting because you can actually get quite a massive fuel saving. And those kind of vehicles tend to have batteries that are about 10 kilowatt hours, whereas a Tesla or a more upscale electric vehicle, they're looking at 70 kilowatt hour batteries. So quite a big difference.
I can give you a direct real world experience with it, because my wife and I just got a plug-in SUV. And our first fill up was 23 liters of gasoline after 730 kilometers covered. Now add in another $13 worth of electricity, and remember that I live in Canada, usually where electricity is relatively cheap. But even so, I cut an awful lot of gasoline use out of my day-to-day use, and I didn't pay an arm and a leg more for a plug-in.
Which is, I mean, that is a very interesting sort of thing, and maybe the world needs to move in that direction. But as you say, that's something that has to be really incentivized by policymakers, as well as the markets, sort of convincing people that this is the right way to go.
Agreed.
I would like to go to Tim, because Tim said something quite interesting, is we always underestimate what we can do in the longer term. And so does that imply that you think that Bert outlined that we just you can't see under any circumstance how we're going to have enough copper, and I suppose that applies to nickel, perhaps even cobalt and lithium as well, that we're not going to have enough of that to meet our 2040, 2050 targets. Tim, you said, we always underestimate what we can actually do. Are we underestimating? Is Bert being unnecessarily pessimistic, or is the shortage real and unlikely to be sort of met?
Look, I think it's a really close line. We've been setting our lithium price forecast not off of a supply demand model and cost of incentivization and whatnot for a while now. We've been sort of looking at it and to James's point, basing it off of where we think it's going to go and that emotional level of driving, and that emotion is a reflection of stress in the market. Prices are where they are today because people need material. You can't deny that exists, and it's a dynamic there. So, and we have points where it's going to connect and disconnect from that dynamic. So you have to be fairly nimble with how you're looking at pricing and what that implies for supply and demand. For example, lithium, we actually have pricing coming back down at the end of this year, and we still have a deficit to market next year. And we describe that as the auction house effect, right? We could talk the Sydney auction effect. If you go to a house auction in Sydney and there's 30 people standing around bidding, the price is much higher than if there's only 5 people sitting around bidding. The market is still the exact same. It's just the difference of buyers and sellers. So we kind of say, I think I've seen a copper supply demand chart that goes out where at year five, there's always a massive deficit. I think there's maybe where, the market's funny. It will find a spot to find that material. And so I don't think it's wrong. We're going to struggle to find that material, and we get those deficits I think they're going to come forward in that, 5 years. There's a massive deficit type conversation. Those deficits are going to creep forward, and that's going to put actual pressure on the consumers, and that'll bid up pricing. And so once you bid up pricing, I mean, I look at the copper sector in Australia, a lot, the big brand names are obviously all those equities have run, but the small caps have barely moved. None of them are pricing, they were pricing in the same thing at $3 a pound, let alone $4.50 a pound. And if we get to $5 a pound at the moment, I just haven't got the inbound interest. And so investors are quite clearly saying to me right now, I don't think copper's going to hold here, which I think is interesting because I think it is going to hold here and probably be higher. I think the days of cheap copper are gone. How do you find it? I think that there's a really interesting part of the equation here to say, if your incremental cost of power for solar, if your day-to-day running cost of solar, when the sun's shining is close to zero for power, do you start seeing more investment in operations that are daylight-only operations? I mean, in Australia, we've got an incredible solar resource. Now, that could, maybe we need to change the way we think about industry, and that's sort of far out thinking. But maybe that's how we find it. We work out a way to do this very, very cheaply, through cheap, almost free electricity once you've sunk your capital. So I don't think there's no easy solutions, and that is the world. There are no easy solutions to finding that copper. We're more likely to be at near deficit markets or close to supply balance for the next 3 to 5 years. And then, my chart says the same as everyone else's. Plus 5 years, it gets really difficult. You need that for 6 escondias or 6 to 8 escondias. You need even more later. So I hope that answers the question where we sort of got to. I think that exists across. The cobalt market is very difficult to find balance after 2025. Over the next couple of years, we see balance in that market, but it's on a knife edge, right? You demand an extra kiloton of cobalt, you're probably pushing that market into deficit, and all of a sudden we're at $80,000 a ton. So we're supportive of pricing there. Manganese, it's the forgotten battery metal. We see it's a bifurcated market there as well, where you've got steel and chemicals. And at the moment, everyone's looking at the total size and saying, oh yeah, we can put more manganese in. Well, the chemical market's 1/10 of the size of the steel market. So it's not easy to expand that chemical capacity there as well. So we'll probably hit a bottleneck there at some point in the next couple of years. Nickel is difficult. Right now, it's so hard after the Tsingshan thing to get a really good read on nickel. One part of me says that this is really bullish and the supply is really tough to find. The other, more cynical part of me says, well, we didn't have a problem in burning Russian oil. I think Australia took a couple of shipments of Russian oil recently. We didn't have a problem burning Russian oil in our cars. Are we really going to care about using Indonesian nickel in our batteries? Yeah, that's the ESG component here, and where we haven't yet seen, again, the capital flow to different projects on their ESG merits just yet. Does that happen? Is pricing going to be connected to ESG? Will be something that is going to test us over the next couple of years, and OEMs are going to have to think about, consumers are going to have to think about it. Because if we don't, then we'll just use Indonesian nickel and we can make that cost fall. And so nickel's hard. One part of me says, I want to be really bullish. The other part of it says, hey, look, Indo's got plenty of nickel and China's sinking heaps of capital. But get cozy with an Indo/China supply chain if you think that that's the dynamic.
Yes, it is. I mean, we haven't even really talked about ESG and the sort of inherent contradiction between trying to meet ESG sort of needs and please how can I put them tactfully, the more environmental lobby, at the same time as actually produce the metals that the environmental lobby will need to meet their goals. There seems to me to be an inherent contradiction in those two things. Mining is, by its nature, it looks ugly, it's fairly dirty. And a lot of environmentalists don't like the idea of mining, but at the same time, mining is needed to meet the goals that they have set for the world. So it's an interesting dynamic. James, sort of looking at the actual state of markets like nickel and cobalt and lithium. I remember not that long ago, I was at a bunch of mining conferences, probably around 2016, 2017, and everybody and their mother was doing a nickel or a lithium project in particular. And then they all went away. There were lots and lots of little Australian companies doing lithium projects all over the place, and then they all seemed to disappear. So I guess the reason they disappeared is that they couldn't make the economics work. Can these sort of things make the economics work now? I mean, are we even close to sort of getting a wave of new money coming in because the incentive pricing is there? That's sort of basically what I'm trying to ask.
Yeah, okay, it's a good question. I think fundamentally my response will be similar to what Bert was talking about before, that the issue is that we've had probably 10 to 15 years of underinvestment in the marketplace, particularly in the exploration and discovery of quality projects. And fundamentally, that is the bed that we've created for ourselves, and we're going to have to exist in that marketplace now, where assets are going to be marginal and difficult to develop. And it's not until we re-incentivize efficient investment into the exploration space that we're going to actually improve or potentially improve the discovery and creation of a pipeline of new investment opportunities in the marketplace. So that is the challenge. So to answer your question directly, I think the issue is that there are a lot of projects in the marketplace that just aren't going to get up. I mean, it is, they're just not the projects that should be being developed. They're just fundamentally not going to be economic until we get to a point of ridiculous sort of commodity prices. So the challenge for us is really more to be able to identify the quality assets that need to be developed. And one issue that I have is that I think over the last 10 years, the listed market space particularly has become a marketplace that, I think the statistic is something like, 2% of the assets through the listed market space actually get developed into mines. So we have a 98% failure rate in the listed market space. So that, is that a market that's going to draw investors to it? Clearly that we have a problem with the marketplace that we've created for ourselves in that it is not efficient in bringing new projects to marketplace that people should be investing in. And the challenge for us now, where we have a potentially step change in demand, is that market, or my perception is that market is not going to be able to respond to that demand change. We need to find a better way to be finding new projects, and we need to be finding a better way to funding and developing those projects.
That raises quite a lot of interesting points there, because I've always felt that the sort of model we had is a lot of relatively small companies doing exploration work, effectively hoping to be gobbled up by a bigger player as they got closer to sort of proving a resource and developing a mine, and then even those mid-tier players being gobbled up by the even bigger players. And that seems to me to not actually really work. I'll go to Bert. Bert, you talked a lot about how we're just not going to have anywhere near enough, the need for multiple new mines the size of Escondida, for example. Who can develop those? I mean, how do we actually get the sort of investment and the exploration that's going to do it? I mean, I would be surprised if it would be smaller companies, out there. I mean, I would imagine it has to really be the mining giants, but from my conversations with some of their executives, they're not focused on new, big, major developing greenfield projects. They're interested in running the existing operations as hard as they can and returning as much money to shareholders, because that's what their shareholders say they want. So how do we actually get the new Escondidas?
Great question, Clyde. I mean, well, first of all, the mining majors, by and large, are not doing a great job on exploration, right? So first of all, it's not a question of developing it. You got to find the ore bodies first, right? Because there's actually, as I said, the 6 to 12, whatever the number is, Escondidas that are going to be needed over the next 15 years, they are not yet discovered. So that's the starting point. It's not even a question of like who is going to build those mines. It's a question, first of all, you got to discover those ore bodies. Question mark. Do they even exist? Another question mark. In the required quantity. So you need a lot of exploration capital. James, I totally agree with you, James. I mean, about the shortcomings of the current capital junior mining model. The problem is, for a junior mining company that assumes exploration risk with other people's money, right? They need to book some big wins. Are they really going to spend the next 5 to 10 years, $50 to $100 million of exploration capital on a potential porphyry? And only after that money is spent, you actually know whether you have a viable large porphyry. Copper porphyries, large ones, are capital and time-hungry beasts, in PHP Billiton, where I previously worked before becoming a fund manager, where we said, large copper porphyry, like 10 years exploration, $100 million exploration risk capital minimum, right? Before you actually know if it's for real or not, right? So there you have these issues. But the answer is, Clyde, it's clearly the large companies, right? But I also wanted to quickly opine on your point with the ESG related capital retreat and obstacles, because I mean, just recently a number of mining projects that should have really moved forward just from satisfying demand point of view have been stopped for ESG and community reasons. Like, I mean, take a look at Rio Tinto's. I think Renison is the name of the copper mine in Arizona, right? I mean, that would have been a really important project to satisfy help satisfy partially North American copper demand for electrification. Didn't happen, and I'm not opining here whether the community reasons or the ESG reasons are the right or the wrong ones. I'm not judging this here, because I lack the insights into the project to really opine here in a qualified manner. But all I'm saying is there are projects, or take Chadar, Rio Tinto in Serbia, right? I mean, these are all projects that purely from a demand point of view, should happen to kind of facilitate the journey towards electrification, zero carbon. But there's a high risk that these projects are not going to happen, each one for the specific reasons. And in that case, it's actually not a technical reason. In that case, it's a community, country, jurisdictional reason. It's an ESG reason or a potential ESG reason. So you actually have projects that actually desperately need it, that actually significantly the risk to satisfy demand that are not going to happen, right? You have in Peru the Rio Blanco project, which is a very big one, right? Not going to happen for community reasons. So you take a look at the supply stack, right? And you can cross out one name after the other. And these are all projects where on each of them tens of millions of dollars, in some cases hundreds of millions of dollars have been spent, right? And you can just simply knock them out of the supply forecast, right? I mean, where are some of the world's largest undeveloped copper deposits? Well, Russia, Udakan. Well, that's not going to happen anytime soon. So all I'm saying is I genuinely can't see where it's going to come from, the supply response. But the other thing is also, James, regarding is the marketplace the wrong one? I mean, you take a look at the valuation levels of a lot of these companies, right, that are out there, right? So again, obviously I'm not using any names here, but I'm pretty confident that if you take a technically educated look at all junior mining companies in the battery metal space that say have more than $300 million market cap, I'm pretty confident that you can knock 80% out of those straight out of the gate. They're not going to happen for reason A, B, and C. And the public market investors don't understand that, because they just by and large go with the thematic. Okay, that's great. There's a lithium shortage, so therefore, boom, we're going to put our money into lithium stocks. Or there's a nickel shortage. So it's not sophisticated capital that makes these share prices and makes these market caps, right? So therefore, for investors like James and myself, right, these valuation levels, even if it were a high quality project, and there are a few in between that are high quality, but very few, the valuation levels, I mean, it's not transactable, because the valuation implies a belief in prices that would be just from our point of view reckless to underwrite in the long term, because as you say, you can have change in battery technology and all comes crashing down again, right? So therefore, the valuation levels for all these kind of very thematic metals that are out there in the market just don't work for us as a basis for pre-money valuation, even if the project makes sense. So yeah, you can work around it maybe with preferred equity deals and structured deals, and one can stay really open-minded about doing that potentially, right? But just as a common equity investor, I would say the valuation levels for a lot of that stuff just makes it in itself impossible to transact. But who knows? Maybe there's enough public market capital out there for some of these projects where investors who don't understand the underlying risks are willing to come in. Because there's a lot of investors out there at the moment who, frankly speaking, don't know what they're doing.
Indeed.
Can I just add to follow on to Bert's comment as well? I think, I think Bert would agree that fundamentally for a quality project at the right price point with an appropriate management team, you know, there is plenty of money available for those projects. I'm sure Bert and I would be very happy to, you know, throw as much money as we possibly can into those assets. But it is, you know, it is a matter of, you know, finding a quality project that's appropriately priced. You know, if you can buy a Escondida for $1 trillion, you're still losing money. You know, it might be a great asset, but you're still losing money. So the point is you have to be looking for projects that are appropriately priced, and the money will come to the table and you will get those mines developed. But, you know, people have to start looking past short-term price escalation. What's my share price going to be next week? To actually, how do I go and get this mine built? Because that, and the experience from people, particularly in Australia, like Fortescue and Gold Road and so forth, that's where you make the real money. And that's how we make an impact on future battery metal supply, by being more effective at bringing money to projects to get things built, rather than worrying about what my share price is tomorrow afternoon.
That's a huge focus in the market of managers looking for quality management, and you know, I think that's one thing that we've certainly been looking at in the last little bit, is making sure those management teams are really good. I think one of the interesting points that both Bert and James point out is, you know, there's a lot of projects out there, and you know, finding, you know, the daily machinations of how the stock price moves. You know, it's almost a societal problem we've got here, where everyone's chasing alpha. You know, everyone wants to make funds, you know, performance, and that's how, after all, everyone is incentivized. You know, funds are marked on mark to market, you know, month to month. You know, I was in a fund prior to this, and we were keenly aware of what our daily performance was. So I think, you know, that's, you know, in where capital gets allocated, you know, I think that's the role of governments to now start stepping in and saying, okay, we do take views on good projects that need capital. They've got a big hurdle, but the funds market at the moment's broken in terms of getting capital allocated to those projects. It's, you know, there's an ongoing discussion I think needs to happen.
Indeed. Well, we're starting to get some questions from the audience, and I'd like to, you know, bring some of those in. The first one was basically, since Russia's attack on Ukraine, has anything changed in the way people are allocating capital into battery metals? Have any of you guys noticed a change in dynamics since this happened? I mean, I know it seems like a long time, but it actually really is only, you know, a few weeks. Has it changed anything, or is it likely to change anything?
Look at the share price performance.
Yeah, I'm happy to talk to that. I mean, I mean, from our point of view, you know, from the long-term investor in the marketplace that has a strategic view, nothing's changed. But what has changed is that, you know, particularly Ukraine has, you know, waved a flag to the investment marketplace to say, you should start looking at this. And I think, you know, certainly from our point of view, a number of significant strategic investors are now starting to look at mining or metal supply and mining, because of the flag that the conflict is created in the marketplace. But that's, you know, that's what's driving. Well, that's one of the drivers in terms of sentiment, that, you know, it waves the flag. People start to look at it. A lot of reports start coming out about how important or how significant this conflict could be in terms of metal supply, and people start to jack up prices and start to reallocate cash. But the strategic long-term view of the marketplace, supply demand, investors, you know, they've been there for a long term.
It's interesting. A lot of people are talking about self-sanctioning of you know, Russia's commodity exports. If that actually happens, and I'm still not convinced it will happen, or it might not happen to the scale that people might expect. If we start to see Russia's exports of things like copper, nickel, aluminium, you know, those sort of metal things start to slide, Will they actually start to slide, or is it just a short-term reallocation of who buys them? So in other words, European people stop buying them and China starts buying them. Does it just, like I'm starting to see in energy commodities, alter the flows around the world, but doesn't really overall change the balances? Or is this something that is actually significant and will have a major effect in years to come as Russia becomes, shall we say, a less investable place? So short-term impacts, longer-term impacts. John, your thoughts on that?
No, well, I don't think that we're going to see anything directly in the quote-unquote battery metals market, at least not to a meaningful degree, because I think what you just mentioned, Clyde, where the buyer is essentially shifted around for a particular allotment of material, but eventually the supply chain works itself out and everything is buffered and cushioned. That's fine. The one area I would add, which is a peripheral concern to us, because if you've got a battery, you've got to have electricity to put in it, is the deep involvement of Russia in the uranium supply chain. Not so much from units that are produced in Russia per se, but from the enrichment side. Without enrichment, you've got little to nothing unless you've got a CANDU reactor running on natural uranium. And frankly, without that very reliable nuclear generated electricity, we're all in a lot of trouble.
Yes, indeed. Another question, slightly different issue, and it's perhaps one for James and Bert. The question is effectively, are people who are seeking to invest in battery metals only looking at mining companies, or are they looking at other parts of the sector, namely recycling, other technologies? What are the thoughts on that? Is it still mainly a mining play, get stuff out the ground, or are people thinking, once it's out the ground, how do we use it more smartly?
I mean, well, first of all, in a growing demand market, recycling can never be the answer by definition, because if you need more metal than is available, then it's already out there, right? So obviously that doesn't resolve it just mathematically. So therefore you cannot say we don't do mining, but we're only going to focus on recycling. The economic, technical, and logistical feasibility of recycling on a broad scale, however, means it's only going to be I think for decades a small portion of the answer. Unfortunately, I think approximately only 5% or 6% of global copper is actually secondary at the moment. Maybe I got this number wrong, but it's in terms of dimension only very, very small portion, right? And the reason is because it's intertwined with a dozen other metals or minerals in most applications, right? So it's really difficult to separate in an economically viable manner. So yes, there should be a lot of investment in recycling and the recycling technology. I think that is absolutely necessary, right? But even if all of that succeeds, you will not get away from the reality that for decades to come, you will need a dramatic increase in primary mining, not just for battery metals, but for a lot of other stuff, and a lot with bold letters underwrite, yeah, even down to metallurgical coal, without which you can't produce the heavy-duty steels that you need for wind turbine towers, etc., right? So you'll need a lot of additional investment in metals and minerals, and there's a total disconnect, right, between what society and politicians think is the reality and what actually the facts are, right? So recycling is an important part of the answer, but all the numbers that I looked at, right, suggest it's only going to be a minority, a significant minority, but only a minority in an optimal recycling case to satisfy the demand that's ahead of us. So therefore, without primary metals mining, nothing's going to happen in terms of journey to zero CO2.
And that kind of leads us into another question that's come in is, we've talked a bit about policy changes that are needed to sort of incentivize investment to happen, technology to be developed, that sort of thing. There was a question to everybody on the panel: what policy changes would you most like to see? John, you go.
Well, on the battery metals side, or at least the battery metals relevant side, stop emphasizing the sale of battery electric vehicles and mandate a level of emissions on new vehicles sold that effectively mean that just about every vehicle is either a hybrid or a plug-in hybrid. Now, that's going to put some demand on the battery metals, obviously, but you can build quite a few hybrids and plug-in hybrids with one Tesla battery. The other part of the equation there is, as you move towards hybrids and plug-in hybrids, energy content is not the sole or most important defining factor any longer. Well, at least one of the important defining factors. The most important defining factor for the auto industry is cost at the end of the day, but at least it's not energy density. And so you can start to look at using lithium iron phosphate or maybe even sodium batteries as Cadle and other companies in China are researching now, where the cost is lower and the critical materials content is less intense. And so all of a sudden you've relaxed the need for some of these critical materials like nickel and cobalt. You've reduced the demand for lithium, either a little or a lot, depending on whether you're able to use sodium batteries down the line. And you're still moving towards an environment where you're using a lot less fossil fuel. Because let's face it, the reason that China is emphasizing new energy vehicle development has nothing to do with a reduction of carbon per se. It has a lot more to do with energy security and with a reduction in pollution and emissions, full stop.
Anybody else? I mean, I've always thought that an interesting thing would be the idea of using electric vehicles as virtual power plants, but that needs policy support. You need to mandate the use of reversible chargers, so that you can charge it during the day off cheap solar and draw it down in the evening, that sort of thing.
My battery's got a limited lifetime, Clyde, and the last thing I want to do is be charging your car with my battery.
Yeah, no, I mean, I recognize that there's all sorts of issues around that. I was reading a very interesting article this morning about how effectively a community battery storage pilot project in Western Australia didn't actually work because while it did what it was supposed to do, it smoothed out, the solar peaks and the evening demands. It couldn't be done at a price that actually made sense for the participants involved. So right. There are all sorts of things that have to be worked out on that. Anybody else got any thoughts on policy sort of changes that would actually be useful and have an impact?
Yeah, more reliable, in a lot of jurisdictions, more reliable approval and permitting procedures for new mining projects were upfront before the real risk capital is actually getting spent. I'm not talking about the exploration now, but I'm talking about all the money that's necessary to travel through the feasibility study stages. Because, in large meaningful projects, you can quite easily ramp up several tens of millions of US dollars along the way there, right? To feasibility study a meaningful project. I think there needs to be a clearer structure in a lot of jurisdictions that if all of those criteria are met, then the project is approved, yeah, as opposed to people spending 50, 60, $100 million, and then we're finding out that there is a source of water that competes with whatever, some other agricultural community 100 kilometers downstream, so therefore after $100 million spent, the project is dead, right, and things like that, right? So I think what would really be helpful, again, sometimes it's also the fault of the mining companies, to be clear, right? There's some mining companies that ignore certain early warning and red flags as well about a project and just move ahead, right? So that's also true. But I think at the same time, it's also true that there's a lot of permitting and approval uncertainties out there, right? And we can talk for hours on that, which countries and which regions, blah, 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 right? But I do think if the world wants a journey to zero CO2, right, that it also needs more permitting certainty and approval certainty for new mining projects, yeah, provided they meet the required criteria to be built, right? So I'm not arguing about recklessly building environmentally damaging projects. I'm not, yeah. But I'm just saying is it would be very helpful to unlock capital if there were in quite a number of places on this planet, yeah, more confidence up front that if the mining investor, the mining company did the right thing, right, that it's actually going to get permitted rather than to be a nail biter until the last moment after a lot of risk capital has been spent, whether there's a permanent project or not, right? So that will be helpful as well.
It's interesting.
Can I just reinforce sort of Bert's point? Because I think that is, from my perspective, that's 100%, you know, the key activity that a government could be undertaking, because, you know, what's come out of COP26, we had a lot of governments come together. We've had a lot of reports saying, yes, we need additional metal supply in the marketplace, which is another point that Bert made. So the governments have got to decide, am I just going to be a gatekeeper and sit here as the last cab off the rank in terms of deciding whether these things are going ahead or not? Or I'm actually going to be a facilitator and participate in assisting the solution. And, you know, that's a key decision for government. And if they're going to be a facilitator, they have to be far more active in the approvals and the selection and approvals process of these projects, so that it isn't at the last minute that a government comes to the table and says, sorry, you didn't get approved. Thanks for spending a couple of $100 million in our country. Goodbye. You know, it's just not going to work. I mean, it's a challenge, and we all need to be collaborating together, particularly including governments, to go and respond to this challenge.
Tim, would you like the last word? Because we're getting close to the end of the session.
Look, I think those are really, you know, very good points that the guys brought up. You know, I think, you know, the discussion around a carbon price and effectively, you know, how do we treat carbon and tax it appropriately if it's a tax or if there's a burden. You know, we need to work out how you jolt the system to try to skew those flows of capital. You know, and it's not going to be perfect. You're going to have to be uncomfortable in this scenario. There is no comfortable pathway to what we're trying to do here. Someone is going to be uncomfortable, and we need to work that out probably sooner rather than later. And the earlier we act, as to John's point, probably the better.
Indeed, it always seems to me that ultimately the person who's most or least comfortable is probably the consumer at the end of the day, because they're the ones who have to pay the ultimate price of all these things being developed. I'd like to thank you guys very much. I think it's been sorry, Bert, or was that?
Yes, well, the consumer and the taxpayer.
Yeah, consumer and the taxpayer. Yeah, same person. Yeah, in many ways. We've reached the end. I think it's been a fantastic panel. I'd like to thank Bert, Tim, John, and James for their contributions. I think if I was to sum it up or try to sum it up, it's an enormous challenge. There's not enough good projects around. There's not enough people investing in them. There's not enough incentive pricing. There's still a lot of uncertainty as to, you know, what future prices will be for all these key metals in coming years. But the demand is likely to be there, and the challenge is going to be how to coordinate all the various moving parts: the capital, the governments, mining companies, the exploration companies, and how to get them all to work together. And that's where I think probably the biggest challenges lie. But anyway, thank you very much.